Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories of the coming week from our Daybreak anchors all around the world. And straight ahead on the program, what's expected to be the latest confirmation of easing inflation, what it means for the Fed and for investors. Plus, earnings from Coca-Cola this week. I'm Tom Busby in New York.
I'm Stephen Carroll in London, where we're looking ahead to the major international gathering of defense officials at the Munich Security Conference.
I'm Brian Curtis in Hong Kong. We look ahead to a lot of economic data coming in Japan and what it means for the BOJ.
That's all straight ahead on Bloomberg Daybreak Weekend. The business news you need to wrap up your week. Available on Apple, Spotify, the Bloomberg Business app, and everywhere you get your podcasts.
Well, good day to you. I'm Tom Busby. We begin today's program with expectations that inflation continues to ease. That's ahead of the Consumer Price Index for January coming out this Tuesday, just ahead of Valentine's Day. And to talk about whether Wall Street is going to love what it hears, we welcome Bloomberg's international economic and policy correspondent, Michael McKee. Michael, what do we expect?
Hearts and flowers for Valentine's Day. CPI is expected to continue the trend that we have seen of gradually slowing inflation rates. The month-over-month number expected to go down from 0.3 in December, which had been revised now down to 0.2, and then stay at 0.2 for the month of January, and that'll push the year-over-year number down to 2.9% from 3.4%. Of course, that's the headline. Because that's pushed around by energy and food, of course, we like to look at the core, and the core is expected to be up 0.3, which is basically where we were last month. But because of base effects, higher inflation in January last year, the core will fall to 3.7% from 3.9%. Now, those are forecasts, but economists have generally been pretty accurate in forecasting the CPI.
Now, let's go back to core consumer prices because we got a reading last week, or confirmation last week, 3.3% in Q4 of last year. That's year over year. And that matches an earlier reading. Good news, though, for the Fed, right? I mean, this is what they were hoping to see.
It's what they were hoping to see because it's not what they saw in 2022. The BLS every year readjusts its seasonal adjustment factors and revises them. And last year when they did that, it pushed inflation at the end of 2022 up and made it look like a lot of progress that had been made was wiped out. So there was some focus on the revisions this year, worried that we might see something similar, but we did not. There was virtually no change in the seasonal adjustment factors. So we end up with, as you say, 3.3% as the 3-month annualized number for the end of the year, and no change there. So in that case, we saw a positive market reaction because no news was good news.
Yeah, we've seen a number of all-time highs for the S&P 500, the Dow. Not so much the NASDAQ yet, but things are definitely looking ahead. And for the Fed, I mean, all signs point to the QE they've been doing, the rate hike schemes. We've avoided a recession. Inflation, slowly but surely declining. The labor market robust. Consumer confidence is up. There are challenges, though.
There are challenges. I don't know if you can say the words soft landing on a public
you can
radio
say it here.
Station here, but the Fed won't say it. But it appears we've basically gotten there. What they need to see now is not dramatic improvements in inflation, but just regular improvements similar to what we're forecast to see this month with a broad number of categories disinflating. Rising at a slower pace. If we get that for a couple of months, they indicate they'll start thinking about cutting rates.
Now, prices outside of core, we know energy, we know food, but one thing in core that has been stubbornly higher is housing.
Yeah.
the recovery we were all hoping for has been so uneven. Every month we seem to get good news, bad news, troubled news about prices. How is that affecting things?
It's just been stubbornly high, and that's not what the Fed or economists expected, because we did see a decline for a while in home prices and rents. Part of it is methodological because of the way the BLS attempts to measure home prices, because a lot goes into the price of your home. It's not just the monthly mortgage payment, but the monthly mortgage payment adjusted by the interest you have to pay and that sort of thing. So they look at rents and ask people, what would your house rent for? And obviously, if you don't sell your house regularly or rent your house regularly, you don't have a good answer for that. So it takes a while for a decline in rent prices to sort of make its way into the CPI. Now, the BLS has started experimenting with a new privately produced sort of data point on rent that measures current rent costs as new apartments and new homes are rented. And they're folding that data in. So there's some hope that we may see a more rapid decline in housing prices to match what we had been experiencing. Of course, with nobody buying houses, there's been a shortage of inventory, and prices have started to go back up again. In that case, the Fed wants it to take a long time to get in.
And if it's not going to happen, it's February. I mean, the heart of the season is coming up.
Yeah, you want to see it now, because pretty soon we're going to be having a lot of people rushing out there. And I saw some analysis recently that said it's going to be a seller's market. They're going to be able to set higher prices because a lot of people want to move but haven't been able to afford it. If interest rates start coming down, then mortgage rates will come down and you will see a much busier housing market.
Now, the Fed meets again March 19th, 20th. It's about 5 weeks away. Between that time, we get CPI, PPI this week. We also get another one for February. If the Fed were to meet right now, what do you think they would say?
They would say we haven't seen enough data.
Yes.
which is going to be their standard answer for a little while. They'll get one more CPI and one more. Of course, they look at the PCE index, and they'll get one more of those before the March meeting. But they'd like to have 2 or 3 months worth. If they wait till May, they'll have 3 months worth of those numbers. And that, in theory, if we continue to see this kind of improvement, will get them to where they want to be, and they can start talking about maybe we cut rates.
So a long road to go before that March meeting. Well, our thanks to Bloomberg's international economic and policy correspondent, Michael McKee. All right, Wall Street's earning cavalcade continues in the week ahead, including reports from Dow component Coca-Cola, one of the best-known brands anywhere. And with a lot more on what to expect, we welcome Bloomberg Intelligence senior industry analyst Ken Shea, who covers consumer products, including beverages, tobacco, and cannabis. Now, Ken, what do you expect to see in Coke's fourth quarter results this coming Tuesday?
So Coca-Cola on Tuesday is expected to put up pretty good numbers. One of the key metrics that I look for is organic revenue growth, because that's the underlying, top line, excluding acquisitions, things like that. We're expecting a high single-digit, 8 to 9% kind of growth, and that's pretty strong. Now, it's a little bit lower than the 15% growth last year, so it's a tough comparison. But that's a pretty good number, and we think they're going to achieve that through a combination of higher volume, some positive effects from channel mix to the on-premise, stadiums, restaurants, people are on the go again, and some carryover higher pricing from last year. And so that's the kind of growth that's very positive. However, we also expect some negative currency, most notably Argentine peso, and a few other things. Dollar's been strong. So net of all that, we'll look like a mid-single-digit kind of growth in net revenue, which is pretty strong.
Oh, that's strong. And you wrote in a report that if there's an earnings beat, this would be the 17th straight one. What does that tell you about Coca-Cola?
That's right. Well, the resilience of the product, Coke's ability to manage operations across geographics that spans up 200 countries around the world. That kind of revenue growth, we think that the company is also enjoying some falling input costs. And so we think with some margin improvement, they can get about 10% growth in earnings. And, without that currency weighing on them, they could probably get mid-teen kind of growth. I think they're going to cite that as well. And as you say, Coke has an ability to exceed expectations, and if Coke comes through, it'll be the 17th straight. And not only do they have a string of beats, but the average beat over that span is about 8%, so it's significant beats also. But I think things to look for in this particular quarter, a lot of investors have cited their concerns about, what could the impact be on these so-called weight loss drugs, the GLP-1 drugs? Could this have an impact on the company's ability to continue to grow if consumers want to, shy away from sugary drinks? Another area of concern is the spike in orange juice prices worldwide. They're up about 40% over last year, and even though Minute Maid and Simply account for only about 10% of Coke's overall sales, nevertheless, a cost increase that high, one has to wonder what its strategy is to grow that orange juice business.
Would that be the only category that you see as a real challenge for Coke right now?
A lot of categories. Coffee is a competitive one, particularly because that's not only a finished product, but also a set of retail operations. Costa Coffee, Coca-Cola has. Costs had come down. Now coffee prices are starting to move higher again. I wouldn't say it's problematic, but it's a more volatile business than a typical Coca-Cola business, which is basically selling concentrates to its, bottling partners, where you have consistently high margins and a steady demand. So that one's going to be worth taking an eye on also. I'm also interested about some of the innovation Coke is up to. It's starting to branch out with some alcoholic beverage partners. Jack and Coke is now a product you can buy off the shelf. Absolute and Sprite's another one. And so they have a lot of, coals in the fire, so to speak, in terms of what they're doing with alcoholic beverage partners. At this point, it's still a small business, but it's worth keeping an eye on.
And they've got a new Coke product coming out just the 19th of this month. What do you know about that?
Well, I haven't not tried it yet. It sounds interesting. Supposedly it's like a Coke raspberry with some spicy flavors. I'll have to try that when I get a chance, because I do have a sweet tooth.
Yeah, Coca-Cola Spiced is the name of it. I think despite the name, it's not spicy, but it is different and unusual, I think, is they're going to make this a permanent part of their lineup right away.
Well, it speaks to Coke's willingness to innovate, market, and be relevant to younger generations. Coke has been around for so long. I think the demographics may have skewed towards older, I wouldn't say old, but older adult, young middle-aged adults. I think this is an effort, their creations line, to tap into younger generation consumers, and hopefully they can hang on for their lifestyle, their lifespan.
Well, it's a lot to look forward. I'm looking forward to trying it. And our thanks now to Bloomberg Intelligence Senior Industry Analyst Ken Shea. Coming up on Bloomberg Daybreak Weekend, conflicts in the Middle East and in Ukraine raising concerns about security all around the globe, and at a special conference taking place this week in Germany. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in the program, a big change expected from the Bank of Japan. But first, geopolitical tensions are a risk that's been featured in companies' earnings reports this season. With ongoing conflicts in the Middle East, Ukraine, and elsewhere, security issues will be at the heart of the gathering of world leaders for the Munich Security Conference in the coming days. For more, let's go to London and bring in Bloomberg Daybreak anchor Stephen Carroll.
Tom, the disruption to shipping through the Red Sea and the implications for inflation have been a topic of discussion for many companies during this earnings season. The CEO of Danish shipping giant Maersk telling Bloomberg they haven't seen a peak in the threat level in the Red Sea, and they see disruption potentially lasting for up to a year. Now, that's just one issue that's going to be discussed at the Munich Security Conference in the coming days. It's an event that's been dubbed by some as the Davos of defence and brings together officials and political leaders in the southern German city. The conversations this year more challenging than ever. Russia's invasion of Ukraine is close to entering its third year, and the Israel-Hamas war that began more than 4 months ago has led to violence in several other parts of the Middle East. Ukraine's President Volodymyr Zelensky is expected to attend the conference, but Russian and Iranian officials haven't been invited. Geopolitical tensions from these conflicts are a major risk for markets, and we've been discussing that with some of our guests on Bloomberg Radio in recent days. Here are the thoughts of Wei Li, Global Chief Investment Strategist at BlackRock.
Yeah, so it's really quite incredible how flat geopolitical risk premium currently is as per being priced by markets. We do think that there is room for that to be priced in more, just given the fact that we're in a different geopolitical regime compared to before, right? So this instinct to just automatically buy the dip across the board indiscriminately whenever something goes wrong on the geopolitical front, it works until it doesn't work. So we do think that it's very important to be selective in terms of positioning for geopolitical events, looking at, for example, where oil is trading, but specifically also energy sector. We talked about earnings maybe not doing as well as some of the other sectors, but we like energy as a sector also as a geopolitical hedge, especially given how little it's responded to geopolitical events so far.
That's BlackRock's Wei Li talking about how traders are positioning around geopolitical risks. Now, we also talked about this with Skylar Montgomery-Koning. She's Director of Macro Strategy at TS Lombard, and she spoke about the economic risks of ongoing unrest.
Markets really struggle to price geopolitical risk because the issue is it's an extreme event that's unlikely. And so in 2020, we had the extreme unlikely event and we had energy prices skyrocket, and that had a big impact on inflation. But it's unlikely to repeat itself. And so because it's very hard to price that risk, markets just kind of ignore it. For policymakers, I think it's background noise. The disruptions we're having right now, we don't think will feed in significantly to inflation. I think the U.S. in particular understands there's a difference between supply side inflation and demand driven inflation. So we don't think it has a large impact on the inflation or it'll cause a reacceleration. I think I'm a bit more worried in Europe because they've traditionally looked at supply side inflation shocks, not so much as a growth negative, but as an inflation positive. And for them, they're also looking at January HICP, which has the potential to upside surprise on seasonality effects. And they may use it as a reason to be more hawkish than they really should be given the growth backdrop.
That's Skylar Montgomery-Koning from TS Lombard there speaking to us on Bloomberg Radio. So that's the markets and the economic point of view on these security issues. How will government officials be addressing these problems at the Munich Security Conference? I've been discussing this with our EU politics reporter Ellen Milligan, and I started by asking her who's attending the event and what we should expect them to be focusing on.
Well, this conference will be centred on maintaining both financial and military support for Ukraine. Often you get, as you said, world leaders attending, foreign and defence secretaries, but also tons of defence officials, the real experts on both Ukraine, the Middle East, the Red Sea. They're likely to discuss the difficulties for Ukraine as this war drags on, in particular the industrial production challenges. Ukraine's grappling right now with depleting ammunition stocks. So we may hear more about joint procurement of military equipment between countries. There may well be some deals announced, as well as perhaps more bilateral security commitments that each ally is designing for Ukraine. The UK's already announced theirs earlier this year. We might get more countries announce their security commitments to Ukraine also.
It'd be interesting to watch the discussions from an EU point of view, Ellen, because after we've had Hungary's wavering over the EU aid package, how much support is there in Europe for Ukraine now? Of course, we're still waiting for Hungary to approve Sweden as a new NATO member as well.
Well, that moment last week when the EU agreed on its 50 billion package for Ukraine was a big sigh of relief, both in Europe but also in the US and around the world. The main focus now actually is on US Congress and whether they will pass that 60 billion in aid there this week. Actually, US National Security Advisor Jake Sullivan came to Brussels and discussed at NATO this package. He said he was confident the Biden administration would get it passed, but just hours later, Senate Republicans blocked a package tied tied to that funding. And Polish Premier Donald Tusk has tweeted that they should be ashamed of themselves. So you're seeing those tensions emerge now that the EU's passed their package between the US and saying kind of, we've got our package passed, now it's time for you to. And as I said, Ukraine is facing some serious ammunition shortages, which Russia is going to try and take advantage on. So it's a really critical point for that aid to come through.
Of course, the Middle East is going to be a huge topic of discussion there as well. The latest proposals for a ceasefire deal reportedly being rejected by Benjamin Netanyahu. How will countries who are going to be represented at the conference be talking about their approach to achieving peace in the region? And I suppose more broadly, how has the Israel-Hamas war affected security ties?
Yeah, I mean, the EU continues to struggle to come to a unified stance on how to approach the situation in the Middle East. Some countries are reticent to pressure Israel over its bombing of Gaza. They don't want to restrict what Israel views as a self-defense of the following the Hamas attacks in October. Some are more keen to push them and pressure them to impose a ceasefire, for example. But I think there are some emerging conversations that will be a topic at Munich. So, for example, recognising a Palestinian state. I thought it was interesting that Foreign Secretary David Cameron in the UK said this week that it's something he'd like to explore. Countries like Ireland or Spain are also considering that. And there's also discussion of the sanctions against violent Israeli settlers, something the US has announced this week and many EU member states want to introduce also. So those are the points of discussion I think we'll see next week.
There's also, of course, going to be focused more broadly from that too on the relationship between the United States and Europe on security issues. We know they haven't always seen eye to eye, particularly when it's come to spending commitments. Where are we now in that balance of relationships, given the pressures that we have from both the conflicts in Ukraine and in the Middle East?
We've had some quite strong language coming out of like Charles Michel, von der Leyen in the EU, as I said, Donald Tusk in Poland, kind of ramping up pressure on the US to pass this aid package. So I think you're going to see more of that language, more lobbying from the EU, the UK, other allies at the Munich Security Conference. There's also been some concern in Europe about recent US strikes on Iranian-backed groups in the Red Sea. There's worry it could provoke an escalation of the conflict. So I think we'll hear more about the differences in approach between the EU, who wants to take a more defensive mission to the Red Sea than an offensive one, and the different approaches to the Houthis in dealing with that conflict in the Red Sea. So those are the areas of contention between the EU and the US. But I also think that they're incredibly keen to stress how united they are. And I think there'll be more kind of joint press conferences. For example, we saw that with Sullivan and Stoltenberg in Brussels this week, and I think they'll want to put on a unified position as well.
It is, of course, Ellen, too, a year of big elections, notably the EU elections coming up in June, then the US presidential election in November as well. Will attendees to the conference be thinking about this in their conversations about what effect that might have on the international security landscape, particularly with Donald Trump in the frame in the United States?
Yeah, I mean, the potential win for Trump, which is looking increasingly likely when you look at US polls, is what is looming over European leaders' minds. I mean, whether it comes to international security, but also in relation to trade between the blocs. We've had some great scoops this week from Bloomberg about Trump planning, a potential trade standard with the EU if he enters office, and the EU mapping out how they want to prepare for that. But when it comes to international security, the thing that's causing real concern in Europe is whether they're ready to defend itself if there's a Trump comeback, and if Putin could target NATO next. Trump has threatened to pull the US out of NATO when he was previously in the White House. He probably wouldn't be able to do that if he's president, but it is raising questions about whether Europe is capable of defending itself without the US. So you're going to have a lot of conversations next week about Europe's own defence industry.
Ellen, I'm wondering too about the relationship between the UK and EU countries on the defence front. You, as someone who's reported extensively from Westminster and now based in Brussels, are very well placed to answer this question for us. Is that a relationship that has remained strong despite the other tensions that we've seen post-Brexit?
Yeah, something that I've heard a lot since I've come to Brussels is that the Ukraine war has actually united the UK and the EU a lot more. National security is one of their strongest areas in terms of allegiances and their relationship. We've obviously seen the UK take a leadership role when it comes to Ukraine, when it comes to the Middle East also, and they announced their 2 billion package earlier this year. That was followed by Germany's 8 billion package. So you're seeing that relationship kind of blossom in this sense, and I think you will see that a lot next week. I think the UK and the EU will jointly lobby the US over its aid package. You saw David Cameron go to Washington before Christmas. I think you'll see a lot more of that and them teaming up to get that passed.
That's our EU politics reporter Ellen Milligan, and we will have coverage of the Munich Security Conference on Bloomberg next week. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, are the world's only remaining negative interest rates about to go away? I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Japan getting close to terminating its interest rate policy, so the country's GDP and economic data will be the focus for the Bank of Japan. Let's get to Bloomberg Daybreak Asia co-host Brian Curtis for more.
Tom, we look ahead to a slew of Japanese data in the coming week to tease out what to expect next from the Bank of Japan. Among the numbers, we'll get GDP for the fourth quarter and industrial production and capacity utilization for December. Now, Japanese wage growth strengthened less than expected in the month of December, but it still showed signs of momentum, and it's thought that that will keep the Bank of Japan on track to end its negative rate regime in the coming months. Joining us for some discussion now is Paul Jackson, Bloomberg economy editor. Well, first, let's talk a little bit about GDP before we get to that wholesome discussion about the BOJ and what it does next. Paul, thanks very much for joining us. So GDP numbers out next week. A return to growth, is that expected?
Yeah, we're expecting a return to growth. And you mentioned the Bank of Japan. Well, look, which central bank in the world wants to be raising interest rates when the economy is contracting? And that was the situation over the summer. That was the biggest contraction since the summer of the pandemic. So, this GDP figure next week is a big checkbox for the Bank of Japan to firmly tick next week and say, right, okay, that's another hurdle out of the way on our march towards raising interest rates for the first time since 2007.
And let's just talk a little bit about the wage negotiations, because we understand that they're key here for the BOJ in perhaps taking a more hawkish shift. What are we expecting there?
Well, the wage negotiations between companies and unions is underway. I think all the expectations are that the deals that they're going to reach are going to be higher than last year, which is about 3.6% last year, so a little bit higher than that. And as long as we get that kind of result in March, then that's seen as kind of the final thing the BOJ needs in place to have everything ready to scrap its negative interest rates. Now, if you look at the GDP figures that are coming out next week, one important element in them is the consumption. Now, if you look at the private consumption in Japan, it fell in the summer, and it's only expected to be around zero in the fourth quarter. So, it's kind of trade that's helping business investment to get this kind of 1.3% growth growth, which is what we're expecting in the fourth quarter. So that points to something that consumers are not really spending. Now, why aren't they spending much in real terms? It's because of inflation. And if you don't have the wages going up enough to counteract or be above inflation, then the consumption is going to be weak, and you're not going to have this positive growth cycle that the BOJ needs. So these wage figures are really key, and we need this kind of growth to really give the BOJ confidence that it can go ahead with rate increases.
Yeah, so the BOJ wants those wages to go up. The economy is not particularly hot, as you say. And we note that one of the deputy governors at the BOJ said that it's really kind of hard to imagine the bank raising its policy rate continuously and rapidly going forward. That deputy governor is Shinichi Uchida. What is he getting at?
Well, I think it's a simple idea, really, that, inflation at its peak in the US was well over 8%, whereas in Japan, we're at 2.3, something like that, depending on which measure you look at. So in terms of the aggressive moves that the Fed had to undertake to keep expectations anchored about where prices would go, totally different to the dynamics in Japan, where we've had decades of falling prices. People are trying to get their head around prices going up. So they don't want to squash out these initial signs that Japan's economy and growth cycle is becoming something that looks a bit more normal than it has done over past decades. So I think what he's hinting at is, okay, we go to zero first, we see what it's like. If it's not looking too like it's upset too much of the economy or markets or companies, then we'll go ahead cautiously from that point on. But we are not going to see the kind of aggressive hike after hike, double hikes that we saw from the Fed happening in Japan.
Yeah, we had some comments in this past week from PIMCO saying that in their estimation, the BOJ would scrap its negative interest rate policy perhaps as soon as March, and it would make multiple hikes. But they were talking about something like 10 basis points at one point, 15 basis points. It takes a long time then to really get measurable gains in that.
Yeah, I think it's going to be a slow move. You mentioned March and April. April is our base case scenario for when the BOJ hikes. March is our risk scenario. If you look at overnight swaps, the risk is about 20% of an early move by the BOJ. And we've surveyed economists, over 50 economists, and their view is that 0.5% is probably about as high as the BOJ is going to get as its terminal rate. So whether it gets that far by the end of next year or not is still an open question, but there is a chance they will.
I'm curious, Paul, the outlook from companies versus individuals. Are individuals, you mentioned that inflation really is an issue for Mr. and Mrs. Watanabe, and it is hurting spending. Companies presumably would like a little inflation.
Well, I think once you get into the dynamic that you can raise prices and people will still buy, then inflation can often be helpful for companies for raising their profits, because in other countries, generally, companies raise the prices a little bit more than they need to, kind of creating a margin of leeway, if you like. Whereas in Japan, they're so reluctant to raise prices, and they'll often raise prices by less than they need to. So it's not as positive for profits as it could be. But I think once we get into this idea of inflation sticking, this is going to be good for companies to be able to increase profits through raising prices. And also, if the Bank of Japan is right and we're in a cycle where wages are also part of the cycle and driving prices, then consumption should recover. But I think we're maybe a year or 2 years out before we can really draw the conclusion as, hey, did they get it right?
Sometimes we don't see some of the differences in policy play out in public in places like China and Japan. I'm curious now the current relationship between the BOJ and the Kishida administration.
Well, that's a good question. If you look at the whole campaign of generating 2% inflation and establishing that target, that was set out in a joint statement by the government and the Bank of Japan back in early 2013. So, the actual target itself stems from a collaboration, working together. Now, if you look at how Kishida's administration has been working through this inflation cycle, it's been offering generous subsidies to the public on energy. It's been paying, at one point, it was paying 20% of people's electricity bills. Quite extraordinary help from a central government here. And some people were saying, well, hold on, if you want inflation, why are you actually lowering inflation by providing all these subsidies? But there is a kind of method in the apparent madness in that it's trying to generate some stability in the cycle by holding the inflation up for a little bit longer until it settles in at around 2%, which is what the target is. Now, one other thing the Kishida administration is doing is it's very aware that inflation is eating into consumption and that the wage growth still isn't high enough. So it's offered some tax rebates that are going to kick in the summer. And so we should reach a point where real disposable income does actually increase at that point, something that should help drive some spending. And hey, when a politician does that, it's always the thought at the back of people's minds, oh, is that some kind of gambit for an early election?
Yeah. And presumably if we see more aggressive action from the BOJ, not that it's expected, but if we do see it, that would be perhaps bad for the government bond market. And obviously it creates some interesting conditions for companies, because if you get a big increase in the yen, that could make it more difficult in some ways for Japanese companies, right? So what are we expecting from the financial markets traversing through this next period?
Well, in terms of the companies, the big exporters with a large global presence, they're loving the cheap yen. It's great for them. It expands all their profits, so they're happy. It's the smaller, more domestically focused companies that feel the squeeze. They have to maybe import some stuff. They're reliant on energy as well. So this kind of stuff is bad for them. So if we head towards this new growth cycle with relatively stable inflation and the yen coming back to kind of stronger levels, there's going to be adjustment taking place, and the big exporters going to be a little bit hit, while the domestically focused companies are going to be feeling a little bit of comfort in it.
Is it a bit too general to say that if you get repatriation of the yen, that the consumers will benefit and they'll be happy because they'll have more buying power with a stronger yen? But the companies, like you said, there's a little bit of a bifurcation. But generally speaking, corporate sector not so happy, but consumers happy?
Yeah, I mean, there's so many dimensions to look at these questions on so many different levels. The implications are different. You look at M&A. I mean, Japanese companies wanting to buy abroad. If the yen is strong, it makes it a lot cheaper to do that, and it makes it more difficult if the yen's weak.
It is so fascinating. Paul, thanks so much for joining us. Paul Jackson, Bloomberg Economy Editor. I'm Brian Curtis, along with Doug Krisner. You can catch us every weekday here for Bloomberg Daybreak Asia, beginning at 9 a.m. in Hong Kong and 8 p.m. on Wall Street. Tom?
Thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on the markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.